This is chapter 3, cost volume profit relationships. And what we're going to talk about in this chapter is how to understand the relationship between a company's costs, its sales volume and its production volume, and its profits. In other words, how do your decisions affect profits? Decisions to raise prices, decisions to incur increased costs. How will these affect prices, and how do profits, and how does volume in general affect profit? So this is helpful to managers when they're judging how different decisions that they're going to make are going to impact profit. So managers need to make decisions about selling price, costs, and volumes. And by understanding the relationship between cost, volume, and profit, managers can make better decisions. And key to all of this is the definition of contribution margin. Contribution margin is sales revenue minus variable expense. So here you can see an example: racing bicycle company. Sales are $250,000, variable expenses are $150,000, giving you contribution margin of $100,000, and this would be your contribution margin here. And contribution margin is going to be used to cover your fixed expenses. And once you cover your fixed expenses, anything that remains is going to be net operating income. It's going to increase your profits. So the whole idea is that sales minus variable cost equals contribution margin, and then you use your contribution margin to cover your fixed costs. And once your fixed costs are covered, everything beyond that is going to be your profit. So how do changes in activity affect contribution margin and net operating income? This is learning objective 3-1. And here you can see the example of acoustic concepts from the textbook, and this is in your acoustic concepts template in the Excel handout. And we start off with an example where we're selling 400 units, and we sell them for $250 a unit. Variable expense is $150 a unit, and therefore contribution margin is $100 per unit. So if you sell 400 units, that would come to $100,000. Variable expenses would be 400 times 150, or $60,000, and contribution margin would be $40,000. This $40,000 contribution margin covers $35,000 in fixed expenses, giving you net operating income of $5,000. So what would happen, let's say, if you sold only one unit? Then sales would be $250 times 1, or $250. Variable expenses would be $150 times 1, or $150. And your contribution margin would be $100. Unfortunately, your fixed expenses are still $35,000. So your net operating income here would be only $34,900. But let's suppose now you sell another unit. So you sell 2 units. So that'd be $250 times 2. Your sales would be $500. Your variable expenses would be $300, and your contribution margin would be a whopping $200. Your fixed costs still $35,000. Therefore, your net operating income would be $34,800. And little by little, each item you sell is going to create another $100 in contribution margin, therefore covering a little more of your fixed expenses, until eventually one day, a long time from now, you're going to have positive net operating income. So let's suppose you sell 350 units. Okay, originally we sold 400. You think you might make a profit with 350? Let's see. 250 times 350 is 87.5. 150 times 350 is 52.5. And that would give you $35,000 in contribution margin. That's just enough to cover your fixed cost. And therefore, your net operating income is going to be 0. In other words, you've now broken even. What would happen if you sell 351? 250 times 351 is 37.75. 150 times 351 is 52,650, and that would give you a contribution of $35,100. So $35,100 minus $35,000 is $100 net operating income. And again, let's look at what happens with 400 units. You're going to have 500 net operating income. And as your sales increase, you can see that contribution margin is going to increase. Fixed expenses are going to stay the same, so net operating income is going to increase. So for example, if you had 425 units, this is what would happen. And what would an additional 25 units do? It would give you an additional sales of 62.5. It would give you additional variable expenses of 37.55. So it would give you another 2,500 in contribution margin. The really nice thing about contribution margin is that it increases with volume. Fixed expenses don't. So your fixed expenses are going to be the same. And therefore, your contribution margin would increase by 2,500. Your fixed expenses are completely covered already. So this would go straight to the bottom line, and your net operating income would be $2,500. Now, what is this per unit? It's always going to be consistent. 62.50 divided by the additional 25 units is $250 per unit. 37.50 divided by the 25 additional units is 150, and 2,500 divided by the 25 additional units is 100, because that is the per unit increase. So every unit that increases is going to give you another $100 in contribution margin, and that's money that's going to cover your fixed costs. And once your fixed costs are covered, then everything above and beyond that is going to go to net operating income. And that's how costs behave, and how activity levels affect contribution margin and net operating. And this provides us with a really great shortcut. We don't have to do an income statement to estimate profits at any particular sales volume. All we need to do is know the number of units sold above the break even, multiply that by the contribution margin per unit, and you can start to figure things out. A good tool to use, I'm not going to go into Racing Bicycle Company here in these slides, but is to go through some of these formulas. That profit equals sales minus variable expenses. Let's use this here. Profit equals sales minus variable expenses minus fixed expenses. So that sales equals selling price per unit times quantity sold, right? Sales in this equation, sales is going to be equal to P times Q, price times quantity. And variable expenses in this equation is going to be equal to variable expense per unit times quantity sold, or V times Q. So we can rewrite this equation, profit equals sales minus variable expenses minus fixed expenses. We can write this into profit equals P times Q, that is price times quantity, minus variable expense per unit times quantity, minus fixed expenses. And then we can rearrange this to be the unit contribution margin, that is the price minus the variable expense, P minus V, times Q, equals your fixed expenses. And that's in essence what we're doing here, is we're phrasing it as this equation. And now we can use this equation to better understand how contribution margin impacts profits. Learning objective 3-2 is to prepare and interpret a cost volume profit graph and a profit graph. Now, here you can see this red horizontal line is your fixed cost. In this case, it was $35,000, if you remember. So $35,000 is your fixed cost, and it's going to be a horizontal line because no matter what the volume is, it's still going to be $35,000. So total fixed cost or fixed expense is $35,000. Variable expense will be a diagonal line. And I'm going to start off, this is going to be total expense. I could also write variable expense only as a vertical line that would go like this, and it would just add a little more work. So I'm just going to do total expense, and it's going to start off at the fixed expense line where that meets the vertical axis right here. So at zero volume, you have $35,000 in expenses. And then as volume goes up, this blue line is going to increase at the rate of your variable cost per unit. So total expense will increase at variable cost per unit. as shown here in the blue line. Blue line again is total expense, and the more units you sell, obviously, the greater the total expense. Revenue is going to be the red line that starts at 0, because if you sell 0 units, you have 0 revenue. And it's going to be a vertical line increasing at your sales price. The slope will actually be the sales price. So the greater the volume, the greater the revenue. And then the area between the revenue and the expense, because revenue minus expense equals net income, the area between revenue and expense is going to be equal to net income and net loss. It'll be equal to net income in this right triangular area right here where it says profit area. But it would equal to a net loss in this area over here on the left. And the difference between these is the break-even point. You can kind of think of this as a bow tie. And the break-even point is a little knot in the middle. So the break-even point is the point where you have 0 profit, and as you can see, the profit gets lower and lower until it hits 0, and then it increases. So here, the break-even point would be at 350 speakers, as we saw, or $87,500 in sales. And this provides us with a nice picture of where we would want to be. Obviously, we would want to be as far to the right as possible, because the further you go to the right, the more speakers that you sell, then the more profit, sales and profit that you're going to make. But you definitely want to be ahead of this dotted line right here, because as long as you're to the right of the line, you're making a profit. If you're to the left of the line, that means you're going to be in this loss area where the revenues are less than the total expense. That's not a good place to be. Learning objective 3-3. Use the contribution margin ratio to compute changes in contribution margin net operating income resulting from changes in sales volume. So let's go to our Excel spreadsheet again and go to increase sales template. And let's suppose that we have a scenario where we sell 400 units at $250 a unit. Variable expense is $150 a unit, so your contribution margin is going to be $100 a unit. Fixed expense is $35,000, so net operating income is $5,000. We can calculate from this what's called the contribution margin ratio, CM ratio, and that would be contribution margin divided by sales. So I actually made a whole column here, percentage of sales, because I like to make columns. And that would be sales divided by sales is 100%. Variable expenses divided by sales is 60%, 150 divided by 250. And contribution margin divided by sales is 40% over here. And that's this formula here. And basically, we could just multiply sales by the contribution margin ratio to figure out the contribution margin. And that's a good thing. So for example, let's say sales increased to $130,000. What would happen? Well then, variable expenses would be equal to 130,000 times 60%, or 78,000, and contribution margin would be 130,000 times the contribution margin ratio of 52,000. Fixed expenses would remain the same, and net operating income would increase to $17,000. So the changes here would be that variable expenses would increase by 18,000, contribution margin would increase by 12,000. Fixed expenses would not change because they're fixed expenses, and net operating income would increase by $12,000. So what would happen if sales increased by $30,000 to $130,000? Then your net operating income would increase by $12,000 to $17,000. Now, the nice thing about contribution margin ratio is it makes these things really easy to calculate. For example, if you want to know how this would impact net operating income, all you have to do is take the increase in sales, 130 minus 100,000 or 30,000, multiply it by the contribution margin ratio, and you get the $12,000 increase. That's the same as what we had over here. No coincidence, this is just a shortcut. Because contribution margin ratio always tells us how a change in sales is going to impact net operating income. And that's what we want to know when we make decisions, right? We want to know is how is this going to impact net operating income. There are a number of ways of doing these problems, but what you want to do now is you want to understand how net operating income is going to be affected by changes in variable costs, fixed costs, selling price, and volume. How are they going to be affected? So let's look at a series of decisions. And again, as always, I'm not very creative here. All of these are in the book, and you could just look at them in the book also. You don't have to watch these videos. You could just read the book. Everything's in the book. So we have the same scenario here, but we're going to do a whole bunch of funky things. Let's increase advertising by $10,000, and I should note that that would be advertising is a fixed cost. The book calls it an expense. Sales would, if we do that, we're going to increase sales by $30,000, 520 units. How would this impact net operating income? So now we have two things that are changing here. We have fixed costs, and we have the number of units sold. So let's see what would happen. Sales would no longer be $100,000, right? Sales would be 520 units times $250 or $130,000. That's sales increasing by $130,000 as it was before. Variable expenses would still be 60% of your sales, or $78,000. So your contribution margin would be $52,000. But now your fixed expenses are going to increase by $10,000 to $45,000. And therefore your net operating income would only increase to $7,000. So what are the changes? Sales would increase by $30,000. Variable expenses by $18,000, contribution margin would increase by $12,000, fixed costs, as we know, would increase by $10,000, and then net operating income would only increase by $2,000. So that's how this decision would affect net operating income. But we can do a shortcut again. This one's a little more complicated than some of the other shortcuts than the last shortcut. Increase in sales would be $30,000. So you multiply that by the contribution margin ratio, which is 40,000, and you get the increase in contribution margin of 30,000 times 40,000 or $12,000. And then you have an increase in fixed expenses of 10,000, giving you an increase in net operating income of 12,000 minus 10,000 or $2,000. And you got to remember that this is going to be the outcome. So if someone comes to you and says, let's spend $10,000 on advertising, you would come back and say, okay, how's that going to increase sales? Logical question to ask, right? And then you ask your accountants, you ask your marketing people, how's that going to increase sales? Then you ask your accountant, how's that going to increase net operating income? And you find it's going to increase $2,000. Is that worth it or is it not? Now go to increase variable cost template. Let's try another experiment. Let's say we increase variable cost by $10 per unit. And we know that if we do that, that would be sales commissions, according to the book. Sales would increase 480 units. So what would happen to net operating income? All right, let's go. So sales would be 480 units times $250 each, or 120. But my variable cost is increasing. So the numbers here are going to be what's going to happen here is going to be a little weird. My variable expense would be 480 units times the original $150 per unit variable cost minus the additional $10. So really, variable cost per unit would be $140 a unit times 480, or $67,200. And I subtracted the variable cost instead of the new variable cost instead of adding it. The variable cost would be $160 per unit, not $140. So that'd be $76,800. Contribution margin would then be $43,200. Fixed expenses are going to stay the same, and net operating income is going to increase by $8,200. So you're going to have here an increase in sales of $20,000, an increase in variable expenses of $16,800, and you're going to have an increase in contribution margin of $3,200. You're going to have an increase in percentage of fixed expenses of 0, and you're going to have an increase in operating income of $3,200. And you might be interested here in the percentage of sales and how it's going to change. This would become 120 there you go. That would be your percentage of sales and how it would change. And again, we could do shortcuts. So we would have an expected contribution margin from the increase under the new regime. Expected contribution margin would be, let's see here, would be 480 units times current contribution margin minus 10. So right now the contribution margin is $100 a unit. It would go down to $90 a unit. So it would be $90 a unit times 480 units, or $43,200. The current contribution margin, and this is just one way to do it, there's a few other ways. Current contribution margin we know is 40,000. So therefore the increase in contribution margin would be 43,200 minus 40,000, or $32,200. So what if the fixed cost increased by 15,000, sales price was cut by $20 a unit, and unit sales as a result increased to 600 units? So what's going on here? They're spending more money on advertising and they're cutting their sales price. And they expect that right now they're selling 400 units. This would increase their unit sales to 600 units. Sounds good, right? What would happen to profits? So try and plug this in, pause the video and try it out. And now let's do it together. Ready? Did you do it? Okay, good. So we would sell 600 units, right? And that would be at a sales price. Wait. Let's put in the unit per unit numbers here first. We would have sales price was $250 per unit minus the $20 decrease, or $230. Variable expenses would still be $150 a unit. So your variable cost per unit would be $80, down from $100. Oh no, it's not looking good. You think it's going to increase or not? What do you think? You did the calculation. Is it going to increase? What's going to happen to net operating income now as a result of these decisions? So we're going to sell 600 units at this great, wonderful new price of $230, or resulting in $138,000 in sales. Variable costs would be $150 times 600 units, or $90,000, and contribution margin will be $48,000. Fixed costs would not be the same. Fixed costs would be $35,000 plus the $15,000 increase that we just had, resulting in negative operating income of $2,000. Not good. So what's going on here is that sales is going to go way up. Variable expenses is also going to go way up, 30,000 to be exact. So contribution margin is going to be an $8,000 increase. All right, that's good. The problem here is that fixed expenses are going to go up by $15,000, resulting in a decrease of net operating income from $5,000 down to negative $2,000, and that really wouldn't be good. And again, what we could do here is we could do a shortcut. There's lots of different ways you could do this. One is calculate the new contribution margin. The new contribution margin would be $80 a unit times 600 units. The old contribution margin was 40,000. So the increase in contribution margin would be 48,000. Would be $8,000. So what if fixed costs decreased by 6,000, variable costs increased by $15 a unit, unit sales increased to 460 units? What would happen to net operating income? Okay, so sales price is going to be the same, $250. Variable expense is going to be $150 plus 15, or $165. So your contribution margin per unit is going to be $85. So you're selling, let's see, 250 times 460 units. You're going to make in sales 115,000, and variable expense are going to be 165,000 times 460 units, or $75,900. So your total contribution margin is going to be $39,100. It hasn't gone up, but your fixed costs are going to decrease by $6,000 to $29,000. So that's going to increase your overall operating income to $10,100. And let's look at these differences again. It would be 115 minus 110. 100 is an increase in sales of 15,000, an increase in variable costs of 15,900. So a decrease in contribution margin of $900. Your fixed costs would decrease 35,000, giving you an increase in net operating income of $5,100. Now, you want to see a shortcut? Shortcuts are always fun. You got to really think about how the costs behave in order to figure out shortcuts. But it's a good rule of thumb just to compare new and old contribution margin and then subtract the increase in fixed costs. So new contribution margin in this case, new contribution margin would be 460 units times $85 a unit. The old contribution margin was plain old $40,000. So you have a decrease in contribution margin of 39,000 minus 40,000, or $900. Then you have a decrease in fixed expenses of 6,000. So therefore, you would have an increase in net operating income. When you're doing these, you really got to think about what you're doing and not just run through it like I'm doing here, of 51. And that's a little neater looking. Now, what if you just wanted to sell $150 and you wanted an additional net operating income of $3,000? That's it. I want another $3,000. That's all. I want to make $3,000 on this deal. Then here's one. What sales price would you set? So the average contribution margin per unit, and this on top of everything else you do. So the average contribution margin per unit that you would want would be 3,000 divided by 150 units, or $20 a unit. So how much would you need to set your price at in order to have $20 contribution per unit? You would add this to your variable cost per unit, which is $150, and you would arrive at a sales price of $170. Now, learning objective 3.5, determine the break-even point. The break-even point is the point where your revenues equal your expenses and profit is zero. There's no loss, there's no profit. You're right on the edge. It's like when we looked at the contribution margin of the CVP chart before. Right here, that is the break-even point right in the middle. We have the same example again. We have two different formulas that you can use. But one formula will get you to the quantity, in other words, the number of units you need to sell. The other one would give you the amount of sales that you need to make in dollars. So let's go over them each. To get the first formula, make this a little larger, the break-even formula in units, let's say profit, like the formula we had before, equals the contribution margin per unit times the quantity units sold minus your fixed expense. So if we would have set profit equal to 0 and rearrange the equation, we would get the Q equals fixed expense divided by the unit contribution margin. Now if we want the sales in dollars, we would have profit equals contribution margin ratio times sales minus fixed expense, right? Because that would be sales times, remember, contribution margin ratio is contribution margin divided by sales. So this would yield you the total contribution margin. If we set profit equal to 0, then sales is equal to fixed expense divided by contribution margin ratio. And these are the key formulas that you need to know. So if we would take this problem and calculate the break-even point in units, we would want to know the fixed expense, and it's easy enough to remember. It's just fixed expense divided by unit contribution margin. Fixed expense here is $35,000, and the unit contribution margin is $100 a unit. So therefore, I would get break-even in units of 35,000 divided by 100, or 350 units. If I wanted to break even in sales dollars, that would be this below formula. Again, I would start with fixed expense of $35,000. The contribution margin ratio, which in this case is 40%, divide fixed expense divided by contribution margin ratio, and you get $87,500. Now your book also points out that if you simply work with this formula, profit equals unit CM times Q minus fixed expense, and plug in whatever numbers you have, you can pretty much get whatever you're looking for. So that's another approach that you can take, and you just drop the numbers in, and again, this way you only have to learn one formula. You can pretty much get it all from this unit contribution margin times quantity minus fixed expense equals profit. Let's look at another scenario for a second at the target profit template. It's in the wrong place. Target profit template. And what if you want to earn a certain amount of profit? So the formula for this is called a target profit, and this would be, I don't want to break even, I want to make a certain amount of money. So how many units would I need to sell, or how many dollars would I need to sell in order to make this many units? And the formula would be that the quantity equals profit plus fixed expense divided by the unit contribution margin. So calculate the unit sales needed to attain a target profit of $40,000. So what I would do here is I would first put in my profit. In this case, my target profit, it says, is $40,000. And then I would put in my fixed cost, which is $35,000. And then I would also have my unit CM, which is $100. And then plug them all into the formula. To get the number of units needed, that would be 40,000 plus 35,000 divided by the unit contribution margin, and you get 750 units. This is the same as the formula before, except just having the fixed expense in the numerator. I'm going to have profit plus fixed expense, the target profit plus the fixed expense. Now let's look at the break even in sales dollars. Again, my target profit, whenever I think of target profit, I think of target store. Fixed cost is 35,000. The unit CM, actually I don't want unit CM here, right? I want CM ratio. The CM ratio is 40%. And therefore, the sales dollars needed is going to be equal to 40,000 plus 35,000 divided by CM ratio 187,500. Now, what I like to do, I like to check my work. So if 750 units or 187,500 is the sales dollars, then if I multiply the number of units needed, I should be able to get the sales dollars. So here you see 750. The sales price is $250. So 750 times 250 is equal to 187,500. So you don't even have to do all of this. You could just go 750 times 250 is 187,500, or you can use this to check your work. And what you just saw was determine the level of sales needed to achieve a desired target profit. Slides are a little out of order today. Now, ideally, there's something called margin of safety. And margin of safety is how far you are from the break-even point. In other words, if I'm really close, like here, to the break-even point, that's not so good. But if I'm over here, it is good because I have a big margin of safety. Basically, your margin of safety is the distance between the break-even point and wherever you are. So the question is, how do you get there? And there's also a margin of safety percentage. So same problem, let's go to the margin of safety template. And we have a break-even in units of 350, a break-even in sales dollars of 87,500. And that's just from before, so we know where that break-even point is. The margin of safety in dollars is the difference between total sales, whether it's your budgeted sales or your actual sales, and your break-even sales. So if it already happened, this would be your actual sales. If you're budgeting it, then this would be your budgeted sales. And then margin of safety percentage, I'll get into in a moment, is going to be margin of safety in dollars divided by total budgeted sales in dollars. And by the way, you could do margin of safety percentage also in units and get the same answer. So margin of safety in dollars, I would take my actual sales. In this case, actual sales are 100,000. And I would take my break even in sales dollars. Obviously, you want to compare sales dollars. And the margin of safety in dollars. And you could take margin of safety in units and multiply it by the sales price and get the same thing. Is $12,500. So that means you have $12,500 worth of safety away from the break-even point. To calculate the margin of safety percentage, you would take again the margin of safety in dollars. That is what we just calculated, 12.5. And actual sales, or total sales, or budgeted sales, whatever it happens to be that you have. And then your percentage would be 12.5 divided by 100, or 12.5%, would be margin of safety percentage, 12.5%. Cost structure refers to the relationship between fixed cost and variable cost. And this is extremely important because you have some businesses that are very heavy on the fixed costs and some businesses that are very heavy on the variable costs. And the heavier you are in fixed costs, the greater your what's called leverage, operating leverage, and therefore the greater your risk. So there are some advantages to having a high fixed cost structure. And one of them is that when you have a good year, it's going to be really good. The disadvantage is that when you have a bad year, it's going to be really bad. And if you take an example of a business with high fixed cost structure, that example perhaps would be airlines. It costs a certain amount of money to run a plane in the air, and that's it. So if the plane is full, you're going to make a lot of money. If the plane is going to be empty, you're going to lose a lot of money. And there's very little you can do about it. So companies with low fixed cost structures have a great deal of stability because their expenses move with their sales. And they make a lot of contribution margin. So for companies in that situation, they're going to have a lot of stability in terms of their profits, because they don't have to worry about covering a high amount of fixed costs. So let's look at some examples of how this works and talk about operating leverage. Learning objective 3-8 is to compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in operating income. So we go to this example of two farms in the book. And we have two farms, Bogside and Sterling. And Bogside has a contribution margin ratio of 40%, which is fairly low, and they have relatively low fixed expenses, $30,000. Sterling Farm, on the other hand, has fairly low variable costs and high contribution margin and high fixed costs. So their variable expenses are only $30,000, but their fixed expenses are $60,000. Giving them contribution margin ratio of 70%. Yet both farms have the same net operating income. So let's see what would happen if sales change and how that would impact each farm's income. And you got to remember that both farms have the same net operating income to start. So let's say sales increase 10%. Your variable expenses would be 100 for Bogside Farm would be 66,000, and your contribution margin would be 44,000. Your fixed expenses would remain at 30,000, and therefore your net operating income would be $14,000. It would be higher. Sterling Farm, on the other hand, is only going to have variable expenses of 33,000, so it's going to have a very nice contribution margin of 77,000. However, fixed expenses will remain at 60,000, and therefore net operating income is going to be $17,000. Now, what if sales drop $100,000? That would mean you have zero sales. And it would mean you have zero variable expenses. So this is the extreme example. There is no sales. no sales. And if you have no sales, that means you have no contribution margin, 0. Well, Bogside is still going to have these fixed expenses of 30,000. Sterling is going to have fixed expenses of 60,000. And therefore, Bogside is only going to lose $30,000. And Sterling is going to lose $60,000. So if you're more profitable, Sterling has a high fixed cost structure, and if sales go up, Sterling is going to go up more than Bogside. But if sales go down, Sterling is going to get hurt more than Bogside. Now, what is the dollar sales to break even? Let's look and see. And for each business, it's going to change. Your fixed expenses, can't let a typo on there. Your fixed expenses for Bogside is 30,000. Fixed expenses for Sterling is 60,000. And your contribution margin ratio for Bogside is 40%. And your contribution margin ratio for Sterling is 70%. So your break even, your dollar sales to break even, is going to be 30,000 divided by 40%, 75,000 for Bogside, and $85,714 for Sterling. In other words, Sterling is going to need to sell more in order to cover its fixed expenses, which you might expect because their fixed expenses are higher. On the other hand, their contribution margin ratio is also higher. That's why we want to do this calculation. Now let's look at the margin of safety in sales dollars. Current sales is 100,000, and the break-even point, the dollar sales to break even, or the break-even point in dollars, is 75,000 for Bogside, 100,000 for Sterling. So the margin of safety in sales dollars for Bogside is 25,000. For Sterling, it's only $14,286. Meaning that Bogside has a much wider margin of safety because it has lower fixed costs. Let's look at the margin of safety percentage. Current sales for Bogside is 100,000, and current sales for Sterling is 100,000. And then we're going to the margin of safety in sales dollars, and I think I mentioned already that you could do this in units. You could calculate the same thing and use units instead of dollars because you're dividing one by the other anyway, so you should get the same result. Margin of safety percentage would be 25 divided by 100 at 25%. For Bogside and only 14.3% for Sterling. So you can see that Bogside's in a much better position, obviously because it has lower fixed costs and it's much easier for that company to cover its fixed cost. Let's talk about degree of operating leverage. And students usually have some trouble understanding this. This would be contribution margin divided by the net operating income. And it shows how a percentage change in sales volume is going to impact profits. So obviously, the higher it is, the bigger the impact on profits. If you have an increase, that's good if you have an increase in sales, right? It's bad if you have a decrease in sales. The higher it is, the riskier your operations are. And it's going to vary based on sales level. So if your sales level up here, your degree of operating leverage may be different from if your sales are down here. Let's do some calculations here. Your contribution margin ratio, your contribution margin for Bogside is, let's see, 40,000. And your contribution margin for Sterling is a nice 70,000. Your net operating income for bauxite is 10,000, and your net operating income for sterling is 10,000. So your degree of operating leverage is going to be 40,000 divided by 10,000 for bauxite, or 4, and for sterling it's going to be all the way up there at 7. So if you multiply this by the percentage change in sale, you should get, based on the definition that I gave you, the percent change in net operating income. But this is going to depend on your sales level, because the higher the sales level, the higher the net operating income, and that's going to affect the ratio. So for example, if I look at this at my break-even point, I can't even calculate operating leverage because net operating income is 0, and you need to divide by 0. So you can't really calculate this at your break-even point. Let's say we go up a little to 80,000. Variable expenses would be 60% of that, 48,000, and contribution margin would be 32,000. Fixed expenses still 30,000. NOI is 2,000. Your degree of operating leverage would be contribution margin divided by net operating income. 32,000 divided by 2,000 would be 16. For 100,000, if we do the same calculations, it would go down to 4. 150,000, it would go down to 2, and 225,000, it would go down to 1.5. So this has kind of a weird property to it, and that makes it a little difficult to handle. This brings us to an interesting problem. Companies oftentimes compensate salespeople by paying them on a commission based on sales. And sometimes they could be giving salespeople an incentive to sell products that have lower profits. So as an example, consider here Pipeline Unlimited. And I don't have a template for this. I hope that doesn't bother you. Pipeline Unlimited has two products, XR7 and Turbo. XR7 has a sales price of $695, variable expenses of $344, and contribution margin of $351. Turbo has a selling price of $749, variable expenses of $410, and a contribution margin of $339. So Turbo has a higher price, while XR7 has a higher contribution margin. If you give a 10% sales commission, then the incentive is to sell Turbo, because the 10% sales commission is going to be $74.90 as opposed to XR7 $69.50, and that's $5. You could buy a cup of coffee with that. You could buy 2 cups of coffee in some places. So there you're giving the salesperson incentive to sell Turbo, even though Turbo has lower contribution margin. The salesperson's better off, you're a little worse off. So it may make more sense to give sales agents an incentive based on which model is more profitable, and that would be to focus on contribution margin. Why wouldn't you just focus on profit? It's possible if you calculate profit as gross profit, that is sales price minus cost of goods sold, you're pretty much doing this. But in that place, if you base it on profit, then the salesperson's incentive is aligned with what the company needs. And that would be to sell the more profitable unit rather than the unit that has higher sales. So now let's talk about break-even point. Break-even point when you have more than one product. Most companies do sell more than one product. And how are you supposed to calculate break-even point and handle decision making when you have more products, what we call sales mix? The concept of sales mix refers to the proportion in which you sell your products. So different products have different selling prices, variable costs. Most companies do not have a fixed contribution margin ratio. There are companies that just mark up everything. One example of a company like that is Costco. Costco has close to the same percentage profit margin on everything that it sells. Most companies are not like that at all. They have some products that are more profitable as a percentage than other products. In other words, some products have a higher markup than others. So that means that they have different contribution margins, and that makes your break-even analysis very complicated. And let's take an example of that. Virtual Journeys Unlimited sells two products, the Monuments DVD and the Parks DVD. The Monuments DVD has a 25% contribution margin, and the Parks DVD has a 50% contribution margin. And here you can see the detailed information about where all this comes from. Now what we could do is we could come up with a weighted average, because we know that total sales are 100,000, total variable expenses are 55,000, giving you contribution margin of 45,000. So contribution margin divided by sales would be 45%, meaning your contribution margin ratio is 45%. Fixed expenses are 27,000, giving you net operating income of $18,000. Now, what is your break-even point? Now, this company is obviously making profit, but where is it? If we take the fixed expenses of $27,000 and we divide by the contribution margin ratio, and again, this is a weighted average of monuments and parks, you're going to get break-even point in sales of 60,000. I'm not going to do break-even point in units because it's going to be nonsense, because I have two different kinds of products here. I can't really calculate that. And you can verify this and see, okay, 20,000 times if you have, right now you have 20,000 sales of monuments, 80,000 sales of parks, that's 100,000 sales. 20% of your sales of monuments and 80% of your sales of parks. So your total is 100% again. So if you have sales of the break-even point is 60,000, then 20% of that should be monuments, and 80% of that should be parks DVD. Now, what would happen if we sold $12,000 worth of monuments and $48,000 worth of parks? $12,000 worth of monuments at a 25% contribution margin ratio would give you $3,000 contribution margin. $48,000 worth of parks at a 50% contribution margin would give you $24,000 in contribution margin. So your total contribution margin would be $27,000. Notice how I cut out a lot of this stuff, because just by focusing on contribution margin, you just don't have to do it. So $27,000 would be my total contribution margin. That's perfect because my fixed expenses are $27,000, and therefore net operating income would be zero. But now, what would happen if the sales mix changed? Because here, in order for this to work, monuments and parks have to sell at a 20-80 ratio. And if they don't sell 20%, 80%, then this whole percentage is completely off and nothing is going to work. So let's suppose now monuments is selling 80,000 and parks is selling 20,000. We're going to flip. Then we would need to recalculate the contribution margin on average. Average contribution margin would go down from a very nice 45% down to 30% because monuments are less profitable than parks. Minus fixed expense of 27,000 would give you net operating income of 3,000, and your break-even point would be 27,000 divided by 30% or $90,000. It would go down from 100,000 to $90,000. So if you have multiple products, you're going to have these complications to take into account, and they would usually assume a certain weighted average of sales between the two different products or more. You could have 10 products, and if your sales mix changes, then this is going to be thrown off.